Hey, before we get started today, I want to talk about some bad actors in our industry right now that are trying to sell fear. The annuity salesman is who I'm talking about. They're using fear of the past election, fear from market volatility, fear about losing money forever. And it's all to sell you a product that pays them the most money. We have done the math on these annuities. They don't make sense, especially the indexed annuities. You need to stay away. I have a white paper we've created just for you. If you've been pitched to annuity or if you have an annuity, go to our website, wiserinvestor.com. Scroll down to the bottom. We have a buyer beware. Why do they keep trying to sell you that annuity white paper? Enter your email. You'll get emailed the white paper, and you can learn more about this vicious process that these bad actors are doing in our industry. Stay away from them. Always look for a fee-only advisor, people working in your best interest at all times, fiduciaries. That's wiserinvestor.com. Scroll to the bottom, subscribe to receive our white paper on why the annuity is a bad deal for you. Welcome to the Wiser Wealth Management Roundtable, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey. How's it going?
You know, I open up every podcast with that statement, guiding you to financial freedom, or we believe the best financial advice should always be conflict-free. It's amazing to me how many people in our industry are not working in the best interest of their client. I read recently that 2% of our industry actually works the way that we do, being fee only, not pushing any individual products, which I thought was I was very surprised by that. I figured we were around 12% by my math, but evidently it was way off there. 2% of our industry works just for the client, not trying to sell a product, which is so surprising. There's, a couple we've talked about here all the time we've had several episodes, I should say, on this topic, but a fee-only firm doesn't sell product, where a fee-based firm actually sells products. So they work in your best interest to develop a financial plan, but when they're done, they put on a different sales hat and they try to sell you an annuity or an insurance or whatever at a different commission rate versus maybe how they're managing the assets. I think that's a failed business model because the client doesn't know when they're being sold something and when that person's working in their best interest. We could fix all the problems that we have in our industry if we just worked in the best interest of the client. Very surprising. But today we're talking about a product, an exchange-traded fund. So just to be very clear, we don't sell exchange-traded funds. We don't receive commissions from exchange-traded funds. We're just talking about the product and how we use it here at our firm and what it is. So let's jump right into that. What is an ETF? Who wants to tackle that?
Well, ETFs are a pooled investment product, meaning that investors pool their dollars together and use a professional investment manager to invest that money in such a way that it meets the objective laid out in the ETF. Now, ETFs are passively managed, it's called, which means that they have a distinct investment strategy that is related directly to an underlying index that the manager chooses to invest like, not in, but like.
So for ETFs are relatively new, so maybe we should back it up and say, what is a mutual fund? Because that's what we've had since the 80s, are mutual funds to invest in, right? So I think I would look at it as if there are 4 people at this table and we all put in a quarter, we have now a pooled investment, right?
So a basket of securities.
Well, right now we just have $1. And then a fund manager is going to go out and decide how to best invest that dollar, right? So he or she's looking out there going, okay, based on my job, which maybe it's to buy a large companies, to find the best ones of the S&P 500. They're going to pick 25 or 30 funds with our dollar and then spread it out for us, right? So that's where we started. And then along came Vanguard offering index mutual funds. Index mutual funds, all they do is they got rid of the manager, we got rid of all the high fees, and we're just buying the index or replicating the index by buying everything. So the S&P 500 is some of the 500 largest companies in the United States. So Vanguard's idea was, well, over a long time period, these active managers aren't beating the index. So let's just buy the index and hold it. And people thought they were crazy when Mr. Bogle created this concept. Turns out he was right. Right? So over the long term, we find that these index funds actually seem to outperform the active managers simply because of fees. Now, maybe not over 3 years, 5 years, even 10 years, there's some actively managed funds that have good records. But over your lifetime, the data is supporting passively managed funds. So here along comes ETFs, right? The first ETF was created in
1993, SPY. But before that, you just mentioned Bogle, an interesting stat showing you how popular they become. His first index investment trust, which was the S&P tracking fund, was in 1975, started with $11 million. And as of his passing in 2019, it was over $441 billion. So obviously there's some growth there with the fund in general, with the market, but showing you how progressive that's come in the last few years, especially. But after SPY in 1993, there's a second ETF, the mid-cap Spider ETF in 1995. And then 1996, the first international ETF. And then along in the 2000s came in 2002, the first bond ETF. So a lot of these ETFs are fairly new things in the industry. So I guess we can go back to discussing kind of how they differentiate themselves and why they're so much popular than mutual funds these days.
Yeah, so it's still the same concept as that investors are putting their money in, and there's a formula, we'll call it a formula, of what stocks are going to be bought when you buy this ETF. Now, I don't want to complicate things, but there are actively managed ETFs now that act very similar to mutual funds. Those are very new to the ETF world. But how we got started was really taking that Vanguard Bogle passive index fund and then putting it into a different wrapper. And what that wrapper enabled us to do was trade it during the day. So instead of having to buy the fund at close of the market or sell the fund at close of market, the ETF allowed for us now to trade the ETF during market hours. So from opening bell to closing bell, you can be in, you can be out. Now, it wasn't really meant for day trading initially. Initially, it was really, a lot of times it was used by fund managers because they didn't know where they wanted to place money to be invested, but they didn't want to miss out on market returns. So the idea was they would buy this ETF, hold their capital there until they could then find individual stocks that they want to invest in. That was the original intention. Another advantage, so we have advantage of an ETF over a mutual fund, intraday liquidity, so we can liquidate at any time, even after hours if you want to pay the premium. It's lower cost, so we don't have fund managers anymore in the ETF world. We're really focused on low cost. So an average mutual fund was around 1.4% for a long time. I think that's come down. But the average ETF, our average portfolios here across the entire portfolio is 0.007 of 1%. So the fund itself is almost free because of how efficient the ETF works. Other part is transparency. So an ETF is going to be reporting its holdings sometimes daily or monthly. You can see what the underlying holding is inside the ETF, which in mutual fund world, it was always very secret. They didn't tell you until you get that quarterly prospectus as what they were actually holding. Where an ETF, you know exactly what the underlying holdings are of that ETF. Another one is tax efficiency. So if we're going to buy an ETF inside a IRA, it doesn't really matter versus the mutual fund as much, but it does in a non-qualified account. So if you buy a mutual fund and that fund manager is buying and selling all day long, all week long, all year long, even though you didn't buy or sell, you still get a 1099 at the end of the year for capital gains in that fund. And if you buy the fund in December, sometimes you're getting a capital gains bill that you didn't even actually earn because you didn't hold the fund for the entire year. So you have to, here along comes the ETF, and through the creation redemption process, which this would be the advanced course. Brad can teach that one on how this works, but we'll just call it through the creation redemption process of how they create ETF shares. They're able to shelter a lot of, if not all, of those capital gains. Back in, we've been an all ETF firm since 2004, but back in the beginning, I remember there was kind of a hit list. It was, hey, these 5 funds pass through capital gains. You would see sometimes the funds would get shut down because of all the people who left the fund because it was so mismanaged. So like an S&P 500 fund, you shouldn't have unwanted capital gains pass through that. I would say that was bad. That was bad management on the sponsor's part. Where in some cases, I remember one year long-term bonds had such significant gains because of economic movement that you couldn't help but get a long-term capital gain sent to you. And that's probably a good thing because if you held the fund the whole year, you made pretty good money. Another one is greater flexibility. So in a mutual fund, you just buy and you hold it. If you want to have an option strategy, if you want to short the ETF, if you want to buy on margin, none of the things we would recommend doing with ETFs, but you have that flexibility to do that with an ETF where you can't do that with a mutual fund.
You just have to be careful. We've mentioned it before, like in 2018 with the inverse ETFs and leveraged ETFs, people thinking they're going to make a quick dollar, not truly understanding the underlying securities within it, as well as just the purpose of these investments.
I remember walking around the Inside ETF conference, which is now called ETFcom. The Inside ETF conference, I remember just doom and gloom, man. And that inverse ETFs took over the conference. Every panel, it could be a panel talking about treasuries. Somehow it would shift back to inverse ETFs. I was amazed how many well-paid professionals didn't read the prospectus and understand how the inverse products work. So you can buy an ETF and it will short the market, meaning that if the market goes down, you go up 3 times. And people during the crisis bought the ETFs for their portfolios thinking that, they're going to make a lot of money as the market goes down. What they didn't realize is the inverse, the leverage resets daily. So when we look at market returns over the year, we see market was down, was it 28%, 30%, somewhere in there in that 1 year time span. But that's not what the inverse did, simply because it reset daily. So if you had a big down day, then you made money, but we had more up days than we did down days. So that means all those up days worked against you. And people lost money. I think if memory serves me correctly, I think the inverse fund, the 2 times inverse fund, was down 16% that year. I'd have to go back and look at that. It's been a year since I've talked about it. But inverse, you have to be careful what's in the name. The same thing happened with low volatility. People, I think it was Power Shares at the time, came out with a low volatility fund that bought all the stocks that don't move much. Basically, it was made up of a bunch of utilities. And inside that ETF, we actually saw more volatility there than we actually did in the S&P 500 because people were running to the name.
It's more of a marketing thing. I mean, they are, like you said, they're still trying to sell you some type of product within certain ETFs. So, that they have a catchy name. Sometimes that attracts retail investors.
Right. Absolutely. Well, there's also some Well, first of all, I will say, and maybe we'll insert this here, is core. We have to focus really on an ETF world. I feel like you have to focus on the core. Large, mid, small. You could do large value, large growth, mid value, big growth. You can do that. But when you start getting off into these sector funds, you run into some issues that I don't know that everyday investors can really handle on their own without some type of professional oversight. But that kind of segues us into what are some of the downsides to ETFs that you have to watch out for?
Well, I think that really the downside to ETFs is that when you're buying an ETF, you still need to know what it is you're buying. And you'd mentioned core, you'd mentioned sectors, inverse, et cetera. There's as many different ETFs as you can imagine these days. So as an investor, you really want to know exactly what you're buying and why you're buying it, where it fits into your portfolio. And when you buy and sell ETFs, since they trade like stocks, there may be commissions involved. So you may pay a commission when you buy it, and you may pay a commission when you sell it, depending upon the firm that you're using and the service that you use. So these are, the spreads are something that we also talked about. Spreads are the premiums and discounts relative to the underlying assets in the ETF. Spreads act like I can't even think of, it acts like a commission almost. So if the spread between what you're buying it at and what you could sell it at is wide enough, that actually eats into the returns that you're getting from that ETF. So as good as they are, because ETFs allow you to buy the entire index of whatever it is you choose, large cap, mid cap, small cap, sector, which like technology or healthcare or real estate or whatever, as good as they are and as wonderful a product as they are for a portfolio, the costs involved relative to the transaction itself are like those of a stock, which can be indeed, commission products.
That's probably a good point to interject where how ETFs are created. So you have these authorized participants, we call them APs, that are within the exchange. And if I buy a share of an ETF that represents the S&P 500, they're actually going out there and capturing all 500 companies on the S&P, put them into a basket and handing me that ETF share, right? So a lot of times the APs are the ones kind of setting the bid and the ask because that's how they make money is on the bid and the ask side of that trade. So for certain ETF brands, there's brand, I mean like Vanguard, State Street, BlackRock, all those funds for the most part trade very efficiently, maybe a 1 penny spread, no different than a stock. However, there's other brands of ETFs that I actually like. I think they have could have great legs in the market, but for whatever reason, I believe it's bad APs. There could be a 5-cent spread. So if it's $1, if it's worth $1, maybe it's 95 cents to sell it, and it's $1.05 to buy it, right? So that's something that you have to pay attention to. You might see a really neat investment, but what is it costing you to get into that ETF? And also too the size of the ETFs. Theoretically, if you're trading enough volume, so it's either 25,000 or 50,000 shares at a time
to create. Yeah, it's 50,000 shares or greater to create a unit of an ETF. So if a buyer is going into the marketplace and they're buying on behalf of multiple clients or a very large client, and they go in with an order to buy or sell, in this case, buy greater than 50,000 shares, the AP will actually go out and buy 50,000 shares times the price per share in the marketplace of all the securities in the index. And they'll take those securities, deliver them to the sponsor. The sponsor will deliver back the shares of the ETF, and then those ETF shares are given to the buyer. So the creation redemption process happens at the underlying security level of the ETF. And that's what makes ETFs trade so efficiently in the marketplace, is that there's these two levels of liquidity. There's the level at the ETF, tradable in the market on the secondary exchange, And then there's the level of the redemption creation process, which is what's referred to as being traded at the primary level, primary exchange, because they're buying the underlying securities. So when you look at liquidity in the marketplace, which is a positive in ETFs, there's two levels for an investor. There is the underlying securities level. How liquid are the underlying securities? And if we're talking about the S&P 500, we're talking about very liquid, generally. Right? And then we're talking about the level of liquidity of the ETF itself. How many shares are out there to buy and how many shares are out there to sell? So these ETFs can be extremely liquid in the marketplace for both the retail small buyer and seller or the institutional buyer and seller.
I saw this during COVID, the COVID sell-off, and I saw it during the financial crisis. I think it was October of 2008, where bond prices had seized up. Bond market was not trading normally, and ETFs became the pricing mechanism for the bonds. It was very, they just kept trading right on through. If you held the individual bond, it wouldn't have been as easy to have liquidity. So that creation redemption process created, allowed investors, allowed the markets to keep moving, which is, a lot of people say at the beginning of ETFs, people say you never want to own bonds in ETFs. And actually the opposite was true. Rather own it through the ETF than probably directly for most individual investors.
Yeah, the bond ETFs had a slower adoption rate for sure. As Matthews mentioned, it was in 2002 that the first one came out, but it really wasn't until later after that great financial crisis that investors saw that there was some benefit to having these in an ETF. And then later on, insurance companies and large pension funds began to utilize them, and it became much more prominent in the marketplace to hold bond ETFs. And there are some technical reasons for that, and a lot of it has to do with the ETF being able to disclose all the underlying holdings to the ETF owner, be it a pension fund or organization that has to turn around and report that on their books and records relative to their year-end accounting and processing at the fund level. So once ETFs were able to do that, it became much more adopted and used frequently.
So we could buy ETFs. We can buy a basket of just about anything today. If you want to own just financials, yeah, right? No Bitcoin yet. But if you want to own financials only, if you want to own tech only, airlines only, you can do that through ETFs. We couldn't do that with mutual funds, and we can do it at a very low cost. We can build portfolios and get in. We can get out if we needed to, but there are still some pitfalls, and a lot of it has to do with the structure of an ETF. So back in the beginning, on my blogs, I had someone post that they would never buy an ETF because an ETF is just a derivative of the market. It's not the real market, and it was completely false. And the person who typed it should have known better. I looked them up, and it was a money manager, and I was like, wow, they don't get it. But when you buy an ETF, you own the underlying assets.
That's correct. And that's one of the major differences from a mutual fund is that in the ETF, you own the underlying assets, and you can ask the sponsor to send you those shares to your brokerage account for those underlying shares. Whereas in a mutual fund, you own shares of the fund, but you do not own shares of the companies that the fund has invested in.
Correct. With an exception. So I still believe today it didn't take hold, but we were early adopters to ETFs, and I've had the privilege of teaching master's classes in Asia about ETFs, participated in the first ETF conference in Amsterdam, and did, I think I was at the second ETF conference that they host every year. And I did 4 or 5 in a row with them down in Florida. ETF.com, by the way, is a great resource for researching ETFs. You just go to ETF.com / and then whatever the ticker is. You can pull up history of that ETF. So I'm always happy to give them a free plug. They're great people, and Matt Hogan and a few other guys that started that are no longer there. In fact, I don't know anybody there. I don't think anymore, but they're still producing great content. There is an exception to owning the underlying assets, and that and what I believe the industry should have gone the way of calling these exchange traded products, which in Europe they do. We don't do that as much here. But there's ETFs and then there's ETNs, which is an exchange traded note. And the difference is how it's structured. So this goes into the weeds a little, probably too much, but just remember in the 1940 Act ETF, you own the underlying assets. In a 1933 Act ETF, you do not own the underlying assets. So an exchange traded note is paying you the performance of something, but it's not, you don't own anything. So case in point, Lehman Brothers, when they went under during the financial crisis, they had 3 ETNs, and they were paying people the performance of certain indexes, right? When Lehman went under, those ETFs went under with them. There was nothing to own inside that ETN. So we don't use ETNs here. Typically, what I've seen in the past was an ETN was used for commodities because if you own the commodities fund, then you're getting a K1 at the end of the year because it was structured as like a partnership. So it was taxed a little differently, where if you own the ETN, you avoided that whole tax issue. But the difference is that if the ETN went under, meaning that it has credit risk. So when Lehman went out of business, those investors lost all their money, even though the index they were tracking was just as healthy as any other day. I don't use ETNs, or we don't use ETNs here, but that is something to be aware of.
You mentioned commodities. It'd be like commodities futures too, like a GLD, a gold one or something like that was initially ETNs.
Yep. Correct. That's right. It was. But your original ETFs were actually unit investment trusts is how they were structured. I think the more normal ones now are more open-ended index funds, I believe. So there's multiple ETFs out there. So like you wonder, well, why does SPY, which is the original S&P 500 index fund, and IVV, State Street's SPY, thank you, Brad, and BlackRock's IVV, what's the difference?
It's in how the dividends are treated.
Yes.
Yeah.
So in SPY, which is a unit investment trust, when a company pays its dividends, the dividends are kind of pushed to the side. Think of it as an escrow account, right? It sits in the escrow account, and then when the calendar quarter comes up, then they pay the dividend to you. Where IVV, those dividends are reinvested into the S&P and then paid back out on the other end at the same time as SPY, right? Mm-hmm. So you get a dividend drag on the SPY, where in the IVV you don't.
Right.
So
in an up market.
In an up market, which market is historically up. So you end up with a little bit of a drag on SPY versus IVV. Not a huge difference, but for us geeks here that follow this stuff, typically I wouldn't own SPY. I'd own IVV or Vanguard's VOO. Now, on the flip side, SPY has more options contracts. So if I was going to be I want to do an option strategy on the S&P 500, which again, we don't do that here. And I don't recommend it for people at home. But I would want to do that on SPY because there's more liquidity on the option side versus the IVV side. So again, how an ETF is structured is important. So we have the unit investor trust, we have grantor trust structure, which is also part of the 1933 Act ETF, which that was the gold shares that Matthews referred to a minute ago. Let's see. And that's true. Then we also have the partnerships as well, which I believe the partnerships are mostly more creative type investments that typically we wouldn't find in most ETF portfolios. So that's really down in the weeds and how all that works. I think the most important thing is that you understand the index methodology, meaning how did the companies that are in the fund get there?
Well, it just goes to show that, that ETFs are not ubiquitous. They're not all the same. They may follow similar or same indexes, but even within the ETF structure, there are differentiating factors. And depending upon what you want as an investor, you can choose an ETF that fits those needs.
That's right. That's right.
Yeah.
So I don't, to take this further, we like ETFs better than mutual funds because of tax efficiency, the ability to trade. We have more options. We have more transparency. But then rolling into how do we deploy that into a portfolio? I mean, honestly, low cost investing. That's what I like about it is that I can build an entire portfolio. Now, all of our ETFs trade for free. Most ETFs trade for free across the world now. So I can build an entire portfolio for less than 0.1% that trades for free. Right? So I mean, I think that's great for long-term investors. If you can save where mutual funds were 1% a year for the rest of your life.
That was when they were better. I mean, if there were A shares were initially upfront 5% you were paying upfront.
Yeah.
Then they became the institutional type shares where the maybe 1% or even expense ratios of 0.5% were pretty good and still are good. But like you said, we're getting below the 0.06% for these ETFs.
In addition, inherent in a core index ETF, you're guaranteed to be invested in the best performing sector at any given time. If you're using active management, and a manager has determined at some point through their decision-making process to invest in these companies or these sectors, but not those companies or those sectors. They can't invest in all. They have a mandate to invest in certain areas. If they are not invested in the best performing sector at any given time, they're missing out. But in a core index strategy, using ETFs, you're always invested in whatever is the best performing sector at any given time.
So that when you say core, make sure we're talking to our entire audience. That means large cap growth and value, not large cap growth or large cap value, but just large cap.
Correct.
And then it's mid cap, both.
Correct.
Small cap, both. International, right? Those are your core asset classes. When it comes to bonds, it'd be like the total bond index. Through Vanguard or
the aggregate,
or the aggregate through iShares, right?
Yes.
So that's how you would use ETFs. Most people should be using ETFs to build portfolios. Is doing that. Well, thanks for listening to this episode of Wiser Roundtable. Our next episode, I think we're going to continue on this topic of ETFs, and I think we'll transition into how to build an ETF portfolio. We'll see you guys next time. Have a great week.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.